Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, part 1, we're going to be discussing financial statements. We're going to take a look at a balance sheet, and my goal is to make it as simple as possible and easy to understand. Every investor should have an idea of how to read a financial statement. You're going to want to watch this video. So today we're going to be discussing the balance sheet, and my goal by the end of this series of these videos is to allow everyone to be able to go through a financial statement and understand it, or have a basic understanding of it. What are financial statements? Financial statements are a collection of summary level reports about an organization's financial results, financial position, and cash flow. They include the income statement, balance sheet, and statement of cash flow. Today, we're going to be discussing balance sheet. Each one of those pieces of the financial statement give us different information about the company. The balance sheet, which we'll be focusing on today, shows what the company owns as far as assets, property, and what it owes, like liabilities and debts and different things like that, and what it's worth, its equity. Income statement shows what a company has earned, what it has paid, and what's the resulting profits or losses over a certain period of time. And the statement of cash flow, cash is king, shows how much cash the company has brought in and how much it has paid out. And cash flow is extremely important because with the cash flow, companies can buy back shares, they can pay dividends, they can invest in themselves, they can make acquisitions. So cash flow is extremely important. Now, if we break down a financial statement, you see the division and how it's kind of connected, where if you have, for example, short-term and long-term debt, that'll flow over to the income statement under interest expenses. But you can also have cash that's gaining interest, and dividends, income state falls under from the income statement and flows to the cash flow statement. You'll see it there, dividends also there. There's a connection, and it's important that you understand the balance sheet, income statement, and cash flow statement. Today, we're going to just be focusing on the balance sheet. We'll understand cash, inventory, accounts receivable, plant, property, and equipment, intangible assets, others, accounts payable, short-term, long-term debt, and liabilities, and shareholders' equity. So what does a balance sheet tell us? What exactly does it tell us about a company? A balance sheet shows what a company owns and owes and how much shareholders have invested. So for assets, this is what they own. This is their cash, their property, their inventory. For their liability or liabilities, this is what they owe. These are their rent payments, wages, utilities, taxes, loans. And shareholders' equity is retained earnings. It's how much the shareholders have invested, what's left over. For total assets, it falls under two categories: current assets, which are short-term, likely to be converted into cash within a year, cash on hand, cash at the bank, trade receivables, and non-current assets, and that's the long-term, not likely to be converted into cash within a year. That'll be fixed assets, long-term investments, goodwill, patent. For non-current, that falls under two categories: tangible and intangible assets. Tangible will be cash, land, equipment, inventory, machinery, and furniture, stock, and bonds. For intangible assets, patents, trademark, copyrights, goodwill, brand recognition. Now, let's look at liabilities. Like assets, there's current and non-current liabilities. Current, payable within a year, arises from routine operations like accounts payable, bank overdraft. Non-current would be payable after a year, arises from long-term funding, long-term loans. More examples of current liabilities would be cash dividend payable, accrued expenses, short-term notes payable, accounts payable, tax payable, unearned revenues. Long-term would be long-term borrowing, deferred tax liabilities, secured, unsecured loan, provisions. What about shareholders' equity? What is shareholders' equity? It is what the business is worth after all liabilities is paid off. Components of stockholders' equity. Stockholders' equity is influenced by several components. There's share capital, and that's amounts received by the reporting entity from transaction with its owners and are referred to as share capital. So if you have a company in the beginning, shareholder equity is the amount invested in the business. For example, there's 1,000 shares, each worth $5, then the amount invested was $5,000. Retained earnings, amounts earned through income referred to as retained earnings and accumulated other comprehensive income. Running total profit less losses less dividends would equal retained earning. And we'll show you when we're building a balance sheet what the retained earnings is. Then there's net income and dividend. Net income increases retained earning while dividend payments reduce retained earnings. You have to pay dividend before you get your retained earnings. So total assets minus total liabilities give you the shareholders' equity. It's essentially called the balance sheet because everything has to be balanced. If you do something on one side, you have to do it the other side. Usually there's a credit and there's a debit. And this is called double entry accounting. Double entry accounting is a standard accounting method that involves recording each transaction in at least two accounts, resulting in a debit to one or more accounts and a credit to one or more accounts. A simple way of looking at this is, let's say we had assets on the left side and liabilities on the right side, just like here. And let's say I take a bank loan of $100. Well, that counts as an asset under cash. I have $100 cash, but I have a loan of $100. So it's 100 here and it's 100 here, equal. Both have to be equal. But there's two options for balancing. The first option is the one we mentioned about the $100 loan. And a second option is keeping everything on one side. So if we buy equipment for $100, we have minus $100 and the equipment 100 positive, which is zero. So let's now build our own balance sheet with these following assumptions. We'll say that issued shares is for $500. So let's just say $500 in common stock. And obviously, with big companies, these are going to be in the millions and billions. But for simplicity's sake, let's keep these numbers low. And let's say we took out a loan of $200 that we're going to pay in 4 years. We bought equipment for $100. We bought inventory for $100 that we eventually sold and made $300 from that inventory. We paid salaries of 50 and interest of 5. And this doesn't include every single thing that you're going to find on a balance sheet, but this is a start. This is a foundation, and you can build on this. Let's take our assets. Our current assets are that $500 cash, and the shareholders' equity is $500 cash. Now we have a bank loan of $200, and you see it there on non-current liabilities. So we have to add that $200 to our current asset of cash to equal what's on the right side. Currently now have $700 of cash because of that $200 loan that's recorded as 200 on the right side, and the 500 of common stock. So the 500 plus the 200 gives us the 700 on the right side and 700 on the left side. This is our balance. We're balanced right now. And let's say we need to buy equipment that costs $100. The equipment that we stated we were going to purchase for $100. So now we have to subtract 100 from the cash and add it to our equipment, doing it all on the left side, still being balanced. So on the next slide, now we have 600 in cash because of the equipment that we bought. And we have $100 in equipment, so that equals 700. But now let's go ahead and buy that inventory for $100. So we take that from the cash, and it's still 700 on both sides. We have the 500 in cash. We have the 100 in inventory, 100 in equipment, And let's sell it now. So we sold our inventory. And when you sell your inventory, the 100 that shows there goes to zero. So original 100 of inventory all sold. So it's 100 minus 100, which is zero. The cash is going to go up 300. We said we sold this item and we made 300 because items were sold to the customers for 300. So everything's still balanced, but we're going to add the 300 and we're going to show you where that goes on the liability side. We're at 800 on the left side. We have to balance it on the right side. And we're going to do this in this slide here. We have 800 in cash, 100 in equipment, giving us 900 in assets. Now let's look at our liability side. We still have that $200 loan. We have that $500 common stock. But now look under retained earnings. We have the revenue of $300 that we made. But how much did it cost us to make that 300? Well, we purchased inventory for $100. So that's where the $200 of retained earning comes. It's the 300 minus the 100 for cost of sales. So now we look at the total shareholders equity. We have total shareholders equity. If everything was liquidated and paid off, this is what the shareholders would owe or own. This is what the shareholders would own. This is their equity. So we add the shareholders equity plus the bank loan, it gives us $900. But now we're going to add salary, $50. So salary has to come out of the cash. So we had the 800 of cash before. We have to take out 50 for the salary, giving us 750. And now that shows under retained earnings, you see 100 for the cost of sales and 50 for the salaries. And it's in parentheses because you're subtracting it. So 300 revenue minus 100 cost of sales minus 50. That's what it took us to make that revenue. We had to pay the 100 for the inventory and we had to pay 50 for the salaries, giving us retained earnings of 150. If we take that 650 of total shareholder equity plus the 200 gives us 850. And if we look at the left side, that reflects that. So our last entry is going to be interest. The interest that we mentioned, it's going to cost us $5, and that has to come out of the cash. On the left side, now from our cash, we had the 750, and we have to take out interest payment. That's what we have to pay, and it comes out to 745. Under retained earnings, now those revenues that took us $300 to make, the revenues that we earned, it took us $100 for the inventory, 50 for salary, and we paid 5 for interest, giving us retained earnings of $145. So if we add that to the common stock, the total shareholder equity, the worth of this company, is $645. And we got to add that bank loan, which is $845 on the right side and $845 on the left side. These assumptions were with cash. So accounts receivable is the amount owed by customers to the company. So if somebody buys something on credit from us, we assume that we're going to receive that money within 30 days, 60 days, 90 days, or whatever. On the balance sheet, it won't go under cash. So let's say we made a sale for $100, it won't be added to the cash like we did before. Instead, there'll be a section under cash that'll show accounts receivable. But on the liability side, where we saw the revenue before cost of sales and all that, the revenue would increase by 100, therefore balancing out the balance sheet. Now, let's say for payable, we purchased equipment and we don't have to pay that back for another 60 to 90 days. So under the assets, let's say we bought inventory of 100, then we'll have a section that shows inventory for 100. Under liabilities, it won't go under revenue, it'll go under accounts payable. You'll see a section that shows accounts payable under liabilities for the 100, therefore balancing it out. That was kind of a quick, brief overview of a balance sheet. And let's just hit a couple of points really quickly. What makes a balance sheet strong? Like, what should you be looking for? Well, I would say you want to see more assets than liability. A strong balance sheet should have more assets than liabilities, that's a good sign. You need more money coming in than going out. Positive net assets are good to see. Net assets are basically the value of your assets after you pay your obligations. So you want to see positive net assets. You want to see strong assets. So assets alone won't make your balance sheet healthy. They have to be active and valuable to count as a positive contributions. A strong balance sheet often has assets that provide value now, not potentially later. You want to see healthy receivables. You want to see maybe a good debt to equity ratio. You can analyze these using current ratios, debt to equity ratios, working capital ratios. These are all signs that are going to show you if this is a company with a strong balance sheet. And again, this is just a brief overview. There's a lot more that can be said about this topic, but I just wanted to provide a basic understanding, kind of give you a foundation and something to build on. I hope you enjoyed the video. Our next video is going to be the income statement. If you enjoyed it, please subscribe, comment, and like, and see you on the next video. Thank you.